this today's. Good evening, everybody, our fellow chartered accountants, for this virtual program of today. On behalf of SIRC of ICAI, I, CA Padmaja Sunkat, chartered accountant from Bangalore, welcome you all for today's webinar on case laws and income tax on international taxation and transfer pricing. We should be playing the ICA motto song now.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
I thank SIRC Chairperson C, who has already conveyed her best wishes for the success of today's session, for giving me this opportunity of being the MC for today. All the attendees are requested to raise their questions in the chat box, and the questions shall be presented to the speaker at the end of the session for her views. I welcome CA Sudha, who is our expert speaker for today's webinar. I would like to share a brief profile of Madam Sudha. CA Sudha Ashok is an accomplished chartered accountant and cost accountant with over 30 years of extensive experience in finance, audit, taxation, and regulatory matters, establishing herself as a leading expert in her field. She serves as a national leader in tax compliance in a leading firm, demonstrating proficiency in both direct and indirect taxes, ensuring adherence to the latest regulatory requirements. With a robust background in tax litigation, she expertly manages cases at various levels, including primary forums, dispute resolution panels, appellate forums coordination, and the authority of advance ruling, showcasing her ability to navigate complex legal landscapes. Her rich experience encompasses corporate finance, accounting, audit, and Sarbanes-Oxley compliance, providing clients with comprehensive financial insights and solutions. Recognized as a strategic partner, CA Sudha Ashok has a proven track record of delivering significant value in the highly intricate and ever-evolving tax environment, enabling businesses to achieve compliance and operational efficiency. She also possesses substantial expertise in international taxation and transfer pricing compliance, equipping her to address global tax challenges effectively. We welcome you, CA Sudha ma'am, for taking out time and addressing us on this topic of various case laws and income tax on international taxation and transfer pricing. Over to you, Sudha ma'am.
Okay, thank you, ma'am. Thank you, Padmaja ma'am, for the introduction. This session today is all about international taxation and transfer pricing, significant case laws. Even though there are a lot of case laws on a day-to-day basis, I would like to talk about the landmark judgments and its impact in the tax practice. And let me just share the video. Yeah. I hope you're able to see the video.
Yes, we are able to see see the PPT. Please
Okay.
go ahead, ma'am.
Yeah. First, let's talk about Union of India versus Azadi Bachao Andolan. This is a classic landmark judgment which shook the entire thing of how the Income Tax Act operates and how it is perceived by the nation as a whole when there is an economic ties which is built up with other countries. Before we start about the case law, let me just brief about Section 90, which is very crucial in this landmark judgment. Section 90, as you are aware, it talks about a double taxation relief. It talks about the central government may enter into an agreement with the government of any country or territory outside India for granting relief. So how the grant of relief is provided, it's basically when an income is earned and it is getting taxed in both the countries. Income tax is charged under the act, which is under the provisions of the Income Tax Act in India, and the income tax in that country or specified territory as the case may be, or the income tax chargeable under this act and the corresponding law in force in that country or specified territory to promote mutual economic relations, trade and investment, or it could be avoidance of double taxation of income under the act, or for exchange of information for the prevention of evasion or avoidance of income tax. Or it could be for recovery of income tax under this act and under the corresponding law in force in that country, where the central government has entered into an agreement with the government of any other country outside India. So basically the Section 90 of the Income Tax Act, as all of us are aware, it is basically, it has a lot of wider impact in terms of taxing the income in the respective jurisdictions and which are the amounts where you could get a relief under Section 90 of the Income Tax Act. So there was a circular 789, which is of utmost significance in this particular case. The circular reaffirmed that capital gains earned by Mauritius-based entities from the sale of Indian shares would not be taxed in India, but in Mauritius. The entire crux of the case is about capital gains tax for an entity in Mauritius, which is holding shares in India, whether capital gains has to be taxed in Mauritius or whether the capital gains will be taxed in India. Just to give a little bit of a preamble, when we talk about a double taxation avoidance agreement, we need to also be sure this double taxation avoidance agreement is not only taking into account the income tax provisions or the tax provisions of the respective territories. DTAs are entered into between the Republic of India and the government of the other countries, basically to ensure avoidance of double taxation could be one of the criteria. It could also be for the prevention of fiscal evasion with respect to taxes of income. And the most important thing is encouragement of mutual trade and investment. That's what is the entire crux of the case law. The case was basically whether an entity which is in Mauritius, if it's going to invest in India and there is a sale of shares which is happening, this is going to be taxed in Mauritius, will also India be taxing this capital gains? That's the entire crux of the issue. So let's go to the facts. The facts of the case was, in the case of Azadi Bachao Andolan, it is basically on the double taxation avoidance agreement. So the main issue was this circular, what we talked about, 789, was challenged. It was issued by the CBDT clarifying that foreign institutional investors and their entities residing in Mauritius would not be taxed in India on capital gains arising from the sale of shares. But again, a writ petition was filed saying that the challenging the entire validity of the circular number 789, wherein it says if this 789 circular is going to be in vogue or it is going to be entertained, what could happen is there could be shell companies which will be formed. Shell companies are those what we are talking about when an entity in India is held by Mauritius entity. This Mauritius entity is basically for the purpose of investment and it doesn't have any commercial substance in that country. It could be again held by say an UK entity or it could be from a US entity or Netherlands or any other country outside India. And the main purpose of this Mauritius entity would be for only holding the shares in India. So because of that, what's going to happen is if this exemption is given that the sale of shares of the Mauritius entity in India is not going to be taxed in India, what could happen is these shell companies which could get posted in Mauritius would be going without paying taxes in India. That's exactly the challenge which came in, where this entire case was revolving, and the circular which was issued with the CBDT was itself challenged in this. So when the High Court ruling came in, the High Court said circular number 789, there was a big debate on how it has to be adopted. But the SC was very clear. The Supreme Court decision set aside. It said the circular is 789 is valid. And it also started talking about things like the crux of the say. It said where agreement exists. So the agreement between a country of India and a country, whether it could be Mauritius or any other country, whether once a notification is issued under Section 90, provisions of such an agreement with respect to cases to which they apply would operate even if inconsistent with the provisions of the Income Tax Act. They said yes. It was held as yes, for the simple reason that the DTA agreements which is entered between countries is not only for pertaining to tax, it is also for promoting of economic ties. So there could be a wider agenda or a strategy by the governments, both the governments, in entering into a double taxation avoidance agreement. So we cannot just surpass those intent behind floating a double taxation avoidance agreement between the countries and just narrow down to the income tax provisions. So that's the reason the Supreme Court gave a landmark judgment here. They said, yes, if there are, would operate even if it is inconsistent with the income tax provisions, but if it is for a larger intent to promote economic ties, because when India entered into Mauritius Treaty, it had a larger interest in mind of promoting economic ties between the countries, and it did want to have more investments, FDI investments to come into India. So what's going to happen if taxes are not paid in India? There is going to be a lot of FDI which is going to come into India. There will be foreign institutional investors who will be investing in India, and hence these things were required by the Indian government to promote its own nation, and hence there was a exemption which was given. So hence it was said the circular is valid. Whether double taxation agreement between India and Mauritius is valid? Yes, it is valid because it is formed between two countries, and it cannot be just not said that it is not possible to just say this double taxation avoidance agreement is not valid. Whether an attempt by a resident of a third party to take advantage of existing provisions is whether it's legal, illegal, it was said no. Because the point is, when the double taxation avoidance agreement is made, it is with an intent to promote certain things. And once it is entered, then an amendment cannot happen, a retrospective amendment cannot happen, and it cannot make the double taxation avoidance agreement itself illegal. So we need to, when we are talking about or reading a double taxation avoidance agreement, we should be clear that we should go into the preamble of the DTAs to see what is the basis on which this DTA is entered into. And if the basis is very clear, then the provisions are also discussed clearly between the countries, and hence a double taxation avoidance agreement is entered into between the respective countries, and it has to be always implemented in the interest of the ties between both the countries, and that's how it is there. So any amendment which can be made, it always can be a prospective, and it cannot be a retrospective amendment. So this was a landmark judgment because it opened up a lot of things in terms of the DTA could also be, it can travel beyond the income tax provisions. It could also be for the economic ties and the relationship between the two countries. And that was very clearly proved in this landmark judgment. And when we talk about an international taxation, and especially on capital gains, this landmark judgment is always quoted in several decisions, and there are several other decisions which has quoted this particular decision in their case laws when they are talking about capital gains transaction. Of course, when this has been amended, because it is basically between the sale of shares for the Mauritius shares in India, there was also an amendment which came in later in the double taxation avoidance agreements because it was entered into with Mauritius and India. They said capital gain taxation exemption were phased out for shares acquired after this date. A 50% reduction in tax was available during a transition period, after which full tax was applied. There was a grandfathering clause which was there. That means any investments, because this came in first effective from amendment came in from 1st April 2017. So a grandfathering clause was also there, which said if you have purchased the shares before this date, you will continue to enjoy the capital gains tax exemption, even if it is sold later. And there is something called a limitations of benefits clause in any DTA. What does it mean? We call it, in short, we call it as LOB. This is introduced to say that I was talking about an entity which is an investment entity in Mauritius, which doesn't have a commercial substance in Mauritius. It was only used for investing the shares in India to claim the capital gains exemption or a benefit. So if that be the case, then what happens is, to avoid this kind of companies being formed in Mauritius just to hold investments in India and not to have substance in the transactions in Mauritius, a limitation of benefit clause was also introduced. What it says is, it is introduced to restrict the treaty benefits to genuine Mauritius-based entities with substantial commercial presence, preventing treaty shopping. So treaty shopping, as we all know, treaty shopping is something where you get the benefit, you see the benefit of DTAA, and you try to promote entities in countries where you have better tax benefits. And so companies were doing treaty shopping in some of the areas to enjoy more benefits. So what it was also meant is, because this case law landmark decision came in, and then we had to honor a DTA provision which is already in existence to promote the economic ties between India and Mauritius. There was also this limitations of benefit clause which was introduced. So in future, what it implies is, in future, you need to ensure Mauritius entities can no longer be just an entity, an investment entity to avail the capital gains taxation, because anyway, there's been an amendment which has happened that it's going to be taxed. But also it is saying that there is a limitations of benefit clause which is introduced in the DTA, which says only genuine Mauritius-based entities who has substantial commercial presence will be given this benefit. So what does it mean? So company cannot be established in Mauritius to just say it will only do an investment, but it also has to show that it has certain employees, certain percentage of employees over there, and for performing the work, it is also doing, say, purchase transaction or sales transaction to just demonstrate that it has a substantial commercial presence in that country. So that's the crux of the first landmark judgment, what we talked about by the Supreme Court. The next one is again, this is a recent judgment which has happened on the Nestle case. And this again, this is in favor of the revenue, but then it was talking about something on a most favored nation clause. Just let me just give a small background on what do you mean by most favored nation clause. The MFN clause is introduced in some of the treaties. We were talking about double taxation avoidance agreements or entered into not only for tax benefits to give, nor to avoid double taxation, but it also for promoting economic ties and for promoting investments. So what MFN clause was given with some of the countries, say for example, India, France as an MFN clause. What does this MFN clause mean? MFN clause means it's the most favored nation clause. It ensures that the country to which the clause applies, it will receive an equal or better treatment than any other third party in the same context. So say for example, there is interest, TDS, withholding tax on, say for example, let's presume that withholding tax on dividends, say for a particular country is 10%. The country which is having an MFN clause can also have a 5% TDS because it will have a better benefit. So MFN clause is introduced in some of the DTAs. Basically, when India wants to enter into those countries and it wants to give a most favored nation clause, maybe they want to have free flow of investments between these two nations, or it want to have more economic ties with this nation. So they might enter into this MFN clause after negotiation with the respective jurisdictions or the respective government officials. If the other contracting state provides a lower rate or other favorable tax treatment to a third state, the contracting state must receive the same tax treatment. That is what this MFN means. So what happens is, say for example, hypothetically, we'll take there is an MFN clause entered into between India and country A in the year 1990. What happens is, there it says there will be a tax rate, withholding tax rate on a particular item at say 10%. So now in the year 1995, there is another country which is entered into an agreement with India, and that is having, say, a withholding tax rate of 5% on that particular category of item what we are talking about. So then what happens is, because MFN clause is there for the agreement entered into between India and the country A, but there is a favorable withholding tax benefit available for country B, this country B benefit can be given to country A. That's what we are talking about for MFN clause. So most favored nation clause is giving a favorable treatment to a tax treatment to a third state. The contracting state must receive the same tax treatment, provided there are certain conditions which are to be met. So what are the common routes which is prescribed under MFN clauses? First one, we talk about a automatic route. What do you mean by an automatic route? So it says that if there is a automatic route, it will give a better treatment to any other party in the same group, then the same will automatically apply to the contracting state. So in the same thing, what we talked about is, in 1990, there is a DTA which has been entered into between India and country A with a certain percentage. We'll take the same withholding tax rate of 10%. And we said in 1995, with country B, India is entering into a transaction which is at 5%. So this automatically, that 5% gets embedded into the withholding tax parameters of country A. So this is the automatic route. There is also one part where it says negotiation route. So negotiation route is, say for example, India-Philippines treaty. The other country to inform or negotiate with the Indian government to provide similar or such low rate under similar circumstances. So there could be a negotiation route where they will say in the DTA, you will get the favorable nation clause provided there is a negotiation between two countries. They will negotiate it and give a similar or a low rate under certain similar conditions. So that will be a negotiation rate. There could also be a third possibility where it could be a mixture of automatic rate and a negotiation route. So both could be there. So in some of the treaties, if you see double taxation avoidance treaties, you will find the application of the MFN clause says that it can benefit from favorable tax laws for promoting cross-border. So these has a couple of things. Either it could be an automatic route, or it could be a mixture of automatic route and a negotiation route, or it could also be a negotiation route per se. So what is the facts in the Nestle case? So what had happened is there had been several cases between the Nestle case, which was sailing through the high courts. And then finally, Supreme Court has put a full stop for this entire issue on the MFN clause, wherein the central issue was whether the MFN clause in the DTAs with OECD countries could be invoked if those countries became an OECD member after the DTA was signed without additional notifications. So that was the facts. So the main issue was if there were companies from Netherlands, France, and Switzerland sought low tax rates on dividends, interest, and royalties, quoting they had a MFN clause. So now what was the issue here? The issue was if the particular country has entered into an MFN clause with another country, the same example what we are talking about with country A, and country B is entered into in the year 1995. Now, 1990 was between India and country A. 1995 was between India and country B. So can we automatically invoke it for a better rate? Or is this country B also an OECD member on the date India was entering into an agreement with them? So this is a very crucial point, because you have to be an OECD member. What this case law has clearly mentioned is you need to be an OECD member for ensuring that you can invoke this MFN clause and arrive at the lower tax rates on the dividends and interest and royalties. So that's what it's all about. So what it says is it's not automatic. Just because you have yet another agreement which is entered at a different time period, but you need to check two things. You need to ensure that there is a notification which is available that's saying that you can use the lower rate, and also that other country should be an OECD member. So in crux, what we are trying to say is, if we are saying that a country is an OECD member and got a most favored nation clause arrangement as per the DTA provisions with India and that country, the other country which is getting a benefit, lower rate benefit later, should also be an OECD member the date on which it is entered with India. So there were several arguments before this saying that, are we supposed to see the date of entry of the agreement between India and that country, or can we see as of today? So in the same case, say for example, there is an DTA arrangement which is happening between India and country C in the year 2000. The country was not an OECD member at all in 2000. But then in 2005, the country becomes a OECD member. So can this be allowed? So it was a strict no, because it was not an OECD member on the date when India entered into a DTA arrangement with the other country. This is basically, it's very simple to understand, for the simple reason that when a country is an OECD member and India is entering into a arrangement with that country, it is in the similar circumstance or similar, because normally the developed nations are part of OECD group. So it's easier to understand the circumstance in which those DTA provisions have been entered into. The same thing can also be applied to yet another OECD country, because it will also be under the same negotiation and similar circumstances under which this DTA would have been negotiated between India and the other country. So HC ruling, High Court ruling in the case, it said did not require a separate notification to apply the MFN clause. It's allowed the taxpayers to directly get a low tax rate, and it could be applied automatically once the country become a member. But SC ruling was very clear. In fact, there was also a review petition made, and this is a recent ruling. The Supreme Court clearly said you have to have a notification and it cannot be automatic. And the country becomes an OECD member after signing the DTA with India is not something which we can look at. It has to be an OECD member on the date in which the agreement was signed between India and the third country. What are the repercussions of this? Because of this, what has happened is, normally when a company is paying royalty, dividends, fee for technical services, there is something called a withholding tax which has to be deducted and then remitted. So if a company is having transactions with a country in which India is having a MFN clause, most favored nation clause, then it will invoke those provisions and go for a lower rate. So say for example, if between India and country A, the withholding tax on say fee for technical services 10%, and then there is yet another country which is getting 5%, then the company would have invoked the MFN clause and it would have deducted that 5%. So then what is going to happen is, if this is going to be the SC has put at rest saying that there should have been a notification and that country should have been an OECD member. So if these rules are not met, if the notification is not done, whatever withholding the company has not made all these years, say for example, for the past 5 years, the company has not deducted withholding tax, it is going to be an assessee in default, and it's going to also have ensure the amount is paid with interest, and also there'll be notices which should come from the income tax department, and then there'll be other consequences which will flow. So that is the significance of this ruling. It not only ensures for the rate, there is also a concept of whether you will take the definition, whether you can take a definition from a particular DTAA. You will know that there is something called a make available clause. When we talk about a fee for technical service, India, UK and India, US talks about something called a make available clause. What do you mean by make available clause? If a service is provided, a technical service is provided by a company which is in UK to a company in India, and that technical service is not made available in entirety to the Indian entity, then withholding tax need not be done, for the simple reason that it is not made available to the company. So what is meant by made available? Made available is basically it is not available for you to perform that service independently in future. So what the companies were doing is, they were also using this definition which is given in other treaties to its advantage. If the country is having an MFN clause and withholding tax was not deducted based on that. So that also will get affected by the ruling, because we are not only talking about the rate difference, it is also talking about the definition which has been invoked based on other DTAs to the benefit of this country's transactions, and hence there is going to be a consequence for the company which has not deducted withholding tax. So this is very important for the chartered accountant who is reviewing it, to ensure that if this kind of cases are available, MFN clause has been invoked by a company and not paid withholding taxes, not deducted withholding taxes and remitted, there could be consequences. So the impact has to be taken in full. So the crux of the issue in this was, in the light of the above discussion, what is the crux of the issue here? What we are talking about? A notification under section 91. We talked about section 90, where it talks about certain parameters, which is very clearly given in section 90. What is the parameters which can be used under section 90? Now, it also says a notification under section 91 is necessary, and it's a mandatory condition for a court, authority, or tribunal to give effect to the DTA. The fact that a stipulation in a DTA protocol with one nation requires same treatment subsequent to its being entered. So that's what we saw. So it cannot be subsequently from the date. So if you're a member of an OECD where MFN clause is there, then the other country should also be an OECD member, and they should get that benefits. Only then that benefit can be provided to the first country which is entered into an agreement with India. And the interpretation of the expression is as present signification. Therefore, a party to claim benefit, same treatment clause. So it has to be ensured that is a member of the OECD. So this is just for information. There are notifications issued by government invoking MFN clause for Netherlands, Switzerland, France, Spain, Belgium. In fact, this is the argument Income Tax Department is also placing it, saying that when there are other notifications which has been issued for various countries like Netherlands, Switzerland, France, Spain, and Belgium, so it makes sure that notifications as a practice the department was issuing. So if you are invoking the provisions of most favored nation clause for withholding tax provisions for payment from India to other country where MFN clause is there, we need to be also clear that the other country is an OECD member, and also a notification is available to this effect. And if you also see those notifications, the notifications are all mainly for the TDS rates, and notifications are not for defining or changing the definition. So what is the definition change? What we talked about? Fee for technical service, whether it will also need to have a make available clause so that a withholding tax has to be deducted or not. So this kind of decisions also needs to be done by means of a notification, is what is implying. Of course, the industry is not in agreement to it, and hence a review petition was also made. But then, of course, the Supreme Court has said this is the final thing. MFN clause, in invoking MFN clause, there should be a notification. We need to see how the industry is going to further represent and how it's going to impact the industry in terms of non-deduction of withholding for the past years. Let's talk about the third landmark judgment, which is on engineering analysis, Center of Excellence Private Limited versus Commissioner of Income Tax. This is also a recent judgment. In royalty, when we see the royalty is defined, Section 916 defines royalty as it is payable by the government. A person, if he is a resident, it is in respect of any right, property, information used, or services utilized for the purpose of business or profession carried on outside India. If he is a non-resident, it is payable in respect of any right, property, or information. And it also says, shall apply in relation to, this is what is very important. So as per the Income Tax Act, royalty has a very wider meaning. Royalty talks about, it is not only talks about a direct payment of royalty, it also says a lump sum consideration for the transfer or imparting of information outside India in respect of any data. It could be a documentation, it could be a drawing, the specification relating to any patent, invention, model, design, secret formula, process. So I think nothing is missed out here, or trademark or similar property. Then the agreement is approved by the central government, and provided nothing contained in this clause shall apply in case of, so there's a proviso also which is available. So now what does it mean? So what we are saying is the royalty here is a very exhaustive definition in terms of it is including everything which could be a potential royalty. It could be a lump sum, it could be a copyrighted product, it could be something use of a particular item, and so it could use those terms. Similarly, what is happening in income from way of fees for technical service? So that's also defined. So here also we are talking about if it is utilized in a business or profession carried on by such person outside India, and if he is a non-resident, utilized in a business or profession carried on by for the purpose of making or earning income from any source in India. And then it also again says fees for technical service. This is very important. It says for the rendering of any managerial, technical or consultancy services, including the provision of technical and personal service, but does not include consideration for any construction assembly. So if a fee for technical service is there for managerial, technical or consultancy, it obviously partakes the character of a fee for technical service, and hence it is taxable as per the income tax provisions. So this case law, engineering case law, is about the Article 12 of India-Singapore DTA, where it was very clearly, it was going into the DTA provisions. So normally when, as you will be aware, normally when a transaction happens cross-border, when a particular transaction has to be paid, when an amount has to be paid from India by an entity to another entity in other country which is outside India, the first thing which needs to be looked into is we need to look into whether it's taxable as per the provisions of Income Tax Act. The moment if it is not taxable as per the Income Tax Act, the matter is settled there. But if it's going to be taxed as per the Income Tax Act, then the DTA provisions have to be looked into to see whether there is a beneficial provision under the DTAA for making the allowing or withholding the tax on the payment made. So it could be, say, for example, there could be a case where, as per the income tax rule, a royalty or a fee for technical service, based on the definition, which is very exhaustive, it says that a tax has to be deducted, a withholding tax has to be deducted on a particular transaction. It could happen that if you go to a DTA provision, you will find that the definition might be a little bit narrow definition in the DTA. Hence, that will give a benefit to the assessee, and hence that narrow definition should be taken, provided all the conditions for taking the DTA provision has to be complied with. Like, say, for example, you need to get a TRC, a no PE certificate, and you need to also get the details. 10F should be filed and things like that. So what we need to ensure is, especially it's a proven law, that when there is a definition which is given very clearly in the DTA, then that definition is what should be considered. Only if there is no definition as per the DTAA for a particular item or a heading, then we go and refer to the income tax provisions. So even in income tax, it's not defined, then we go into other modes to see whether there is a definition available for a particular heading. So in this particular case, in India-Singapore DTA, it was very clearly said royalties and fee for technical services arising in a contracting state and paid to a resident of the other contracting state may be taxed in that other state. However, fees for technical service may also be taxed in which they arise and according to the laws. But if the recipient is the beneficial owner of royalties or fee for technical service, it says the percentage also. But what they also did in the DTA is very clearly in India-Singapore DTA, it's been defined how the royalty term has to be taken into account. So it said royalty under this article means any copyright received as a consideration for any copyright of a literary, artistic or scientific work, including film or films or tapes used, trademark, design, model, plan, secret formula or process for information concerning industrial, commercial or scientific experience. And it also talked about any industrial, commercial or scientific equipment other than payments derived by an enterprise. So what does it mean again for us? We talked about what is given in income tax provisions and what is given in the definition given for royalties in India-Singapore DTA. Similarly, in India-Singapore DTA, fee for technical service also defines an ancillary or subsidy to the application or enjoyment of the right property or information, make available technical knowledge, and it consists of the development and transfer of a technical plan. So now, as we saw this case law, it was basically for payments for software use or resale via end user license agreement. So in this particular case law, what had happened is between the entity in Singapore and the entity in India, there was an end user license agreements which was entered into, and the High Court, Karnataka High Court, said that payments made by Indian entities to foreign software constitute royalty since the software transfer involved a right or interest in the copyright. However, when it came to Supreme Court held very clearly that payments made by Indian end users or distributors to foreign software suppliers were not for the use of copyright and thus does not constitute royalty. This is very, very important decision when we are talking about a royalty, because we have to go by the underlying document, the end user license agreements. We have to be very clear whether there is a copyrighted product is getting sold or it is a use of a copyrighted product. So what is the difference? So if I have a product which is copyrighted and that is sold, the transfer of copyright itself is done, then what could happen is we can make any changes and the product becomes that of the ownership is that of the entity which is purchasing it. But if you're only given an option to use the particular software, then you're not literally the complete owner. Then in those cases, they have said that making the payments for goods, not royalties, and they have very clearly distinguished what is a copyrighted product and use of copyright. This has a very wider meaning and it has a greater significance when we are talking about especially the software licenses, because there are a lot of software payments which is being made from India to other countries. We have to go by the substance and the form there to ensure how the agreement is worded. Is it a copyrighted product? Is it a use of license? And the definition, what is given in the particular DTAs have to be referred into. If the DTAs are silent about it, then we need to see as per the Income Tax Act. But in this landmark judgment, especially the India-Singapore DTA, it was very clearly clarified because it's only a right to use and it cannot be taxed under, and hence withholding tax is not applicable. So we talked about this, whether license for use of a product under the end user license agreement cannot be constituted as a license spoken of in section 30 of the Copyright Act. So they also brought into mention of what is provided in the Copyright Act, and then that those clauses also has been given as part of the judgment, and hence amounts paid by the resident Indian end users or distributors to non-resident computer software manufacturers is not payment of royalty for use of copyright. Okay. Next, let's go into the yet another which in most of these structuring advices between countries, this is something which is always quoted at both sides. The Formula 1 World Championship versus Commissioner of Income Tax. This is again a landmark judgment. So here what has happened is the main issue was the Formula 1 case. It was the World Championship. It was a UK-based company and it was hosting a Grand Prix event at the international circuit owned by JP Sports. So there was a person, JP Sports, who was there in India, who's in charge of those relay for the international circuit. And the issue here, the legal question, what was coming in is whether this international circuit, will it constitute a fixed place PE for the Formula 1? That was the complete crux of the entire thing. So what it means is, to just give a background of what happened behind for this particular transaction is that the agreements between the parties happened outside India. The payments also happened outside India. It's only that the event happened in India and which was also done by an Indian resident. Whether there is a permanent establishment which is getting triggered for the non-resident in India is a question, because the moment a permanent establishment gets triggered, then what happens is, then we need to also be clear that the profits which is earned by the non-resident in India becomes taxable in India. So here again, High Court and SC had the same view here. The Supreme Court said it had the non-resident, which is Formula 1, had a PE in India as it controlled the circuit during the race. So this is very, very important. So hypothetically, let's take an example. There is a non-resident who's there, say, for example, in Singapore, and that company entity has a place of business available in India at its disposal. It doesn't happen that it carries on the business regularly in that premises, but it is available with it and it's carrying the business over there, even if it is going to be for a short period of time. That creates a fixed place PE for the entity in India, and hence any profits which is attributable to those activities which is done in India is going to be taxed in India. So that is the crux of the entire issue. And when especially this case is being quoted because this is a landmark judgment for a fixed place PE, where it was very clearly said that it doesn't matter whether it is going to be for a shorter period. It doesn't matter that they have to be regularly available for the thing, even if it is going to be a short-term period. If it is available for the non-resident for carrying on its business, or through it the business is carried on, then it becomes a fixed place which is available at the disposal of the non-resident, and hence it is getting taxed. Okay, the next case law in this particular international taxation area is again a judgment on SAP Labs versus income tax officer. Here, let's just go to the background of what is happening in the transfer pricing perspective. So this is a case law under transfer pricing provisions. As per the transfer pricing provisions, the arm's length pricing. So when there is a transaction, an international transaction between an entity in India and another entity outside India, be it, say for example, we just assume that it is an entity which is in UK. So if there is a transaction between India and UK entity, that has to be proved whether it's at arm's length. So as you are aware that there are methods which is also prescribed under the provisions of the Act. The methods are basically a transaction net margin method. It could be a comparable price method. It could be a cost plus method, a resale price method, a profit split method, or such other method as may be prescribed by the mode. So these methods prescribe basically how an arm's length pricing can be determined. So any of these methods can be chosen. In most of the cases, of course, transaction net margin method is used because either a comparable uncontrolled price or a resale price or a cost plus method is not applicable or appropriate for the transactions entered into between the Indian entity and the non-resident. So as you're aware, this computation of arm's length pricing happens and it is certified by a chartered accountant before the due date, and a form 3CB is filed by the company for substantiating that it's at arm's length pricing, the transaction which is entered by the Indian entity, which is overseas entities. So the computation of arm's length price, even though it is that of the company which is getting certified by a chartered accountant, income tax can send a notice and then the entire case can be taken up for scrutiny like your normal scrutiny and the assessment is handled by your transfer pricing officer. So in the particular case of SAP Labs, whether the issue is if an arm's length price is determined. So as you're aware, when we are talking about an appellate forum, so when there is a addition which is made by the income tax department and there is an appeal which is lying with the Commissioner of Appeals and the tribunal, it is always on the question of fact-finding authority stops with the tribunal. So if it's a question of law, then it travels to the High Court and Supreme Court. So in this case, what was happening is basically there were a lot of entities which was having this arm's length pricing, which was certified, duly certified, and there were some comparables which was selected by the company to substantiate the arm's length pricing, which the company has used during the particular year. So say for example, there is a company which is a software company and with the same function, risk and assets employed by the company, the function profile and the risk assumed, the company gets into a set of say 10 comparables. These 10 comparables margin are considered under transaction net margin method, and there is a percentile method which is worked out between the 35th and 65th percentile, and the company's profitability margin is equated to that percentile what is worked out, and then it is substantiated to be meeting the transfer pricing provisions, and it is said that it's arm's length price. So here, so there were cases where when there is an addition which is made by the TPO and there is an CAT appeals, Commissioner appeals accepts it, the matter travels to tribunal, and if tribunal passes an order, it was constituted that the tribunal's order is final. The matter cannot travel back to High Court because for the simple reason that the High Court in this particular case said the matter of comparable selection and arm's length determination rests with tribunal, and tribunal is the final authority for passing an order, and High Court cannot intervene in that authority. So that's exactly the case. So what was happening is all the companies which was having a transfer pricing addition, which was traveling all the way to tribunal, and tribunal passes an unfavorable order, they were not able to take it to the higher forum because high courts were rejecting it, saying that it is a question of fact, it's not a question of law. Question of law is not available in this particular case of selection of a comparable and determining the arm's length price, and hence the High Court would not be in a position to pass any judgment on this. But what could be the situation here is the assessees who were traveling all the way to tribunal and they were not getting a favorable order, and because they were not able to take it as a question of law, they were not able to get a favorable decision. So this was the crux of the entire decision, and then the High Court has reversed the order of the High Court and they remitted the issue back for all these assessees. And what they said is, it is not that if the tribunal has passed an order for determining the arm's length price, it cannot be constituted as final, because the transfer pricing also has to be clear that evidence, whatever is a question of law, a question of fact can turn into a question of law when the provisions of the transfer pricing provisions have not been strictly followed by the tribunal in ascertaining the arm's length pricing or passing the judgment. Or it could also be that there is an evidence which is supported by the company and that evidence is misread. It is not properly articulated or it is not properly used, and provisions is not properly applied for passing the order. So these could be reasons when a question of law can be converted into a question of fact can be converted into a question of law, and hence High Court has every authority to also hear the matter back and then take it afresh and then decide the case accordingly. So this was again a saving grace for all the assessees, because they were struck saying that it cannot travel beyond the tribunal, because if a comparable is selected, a set of comparables is selected, and there is an order which is passed by the tribunal, then they didn't have an option to raise a question of law in this particular TP assessments to go to the High Court. And this has been settled because SC said if the provisions of transfer pricing is not followed, then they have every liberty to go to the High Court. And in this particular case, because High Court didn't hear out the case, it was remitted back to the issue was remitted to High Court to decide and dispose the appeals afresh. So here the crux was, while determining ALP, tribunal has to follow guidelines stipulated under Chapter 10, namely Sections 972, all the provisions of transfer pricing, and also the rules relating to transfer pricing, which is starting from 10A, and any determination of arm's length price. Relevant provisions of guidelines can be considered, and it may be considered as a substantial question of law. They said, yes, it can be done. And whether in an appeal challenging determination of arm's length price, it is always open for the High Court to examine in each case. And so what was also very clear in this judgment is that it has to be applied case to case. We cannot decide unilaterally for all the cases saying that whatever the tribunal has passed is the final order, and there is no reason the assessee can go to the High Court challenging a question of law on the matter of transfer pricing, and it has to be done on a case-to-case basis. Determination of arm's length price in tribunal and cannot be subject matter of scrutiny under 260A cannot be accepted. That also is something which Supreme Court has said yes, and then it was remitted back to the High Court. The next case is on Vodafone International Holdings. This again, the cases whatever is taken as a subject matter for discussion on international tax and transfer pricing are those landmark judgments which either had an impact on the complete way what has been construed all these days, or it could be something which is going to put something in rest, the litigations, what was happening for the companies through the years, or it could also give a explanation or a special status to what has been understood by the SSE so far, like what we were talking about in the case of MFN clause. What should be done in future is something which is very clearly clarified, that the companies have to expect that there is a notification which is available, or it could be something where royalty, when we are talking about a royalty, whether it is something which has to be a copyrighted product or it's a right to use. So those kind of things has been very clearly laid out in these landmark judgments. And these are landmark judgments. In fact, I have only produced the crux of these landmark judgments for the benefit of the people who are part of this webinar. But you can feel free to just go through the judgments, what is there. And it is really an eye-opener to see the way the cases were argued and the way they have referred all the other cases in the particular judgments and how it has come to light, the conclusion what they have derived for these judgments. In the case of Vodafone, again, this is a part on shares. Vodafone International Holdings BV, they acquired a majority stake in SR, which is a telecom company, and they had a complex corporate structure. So what is meant by a complex corporate structure? There could be an entity in India which is held by somebody in Hong Kong. The Hong Kong entity must be held by, say, Dubai, and the Dubai entity will be held by something in UK. UK must be held in US or in Netherlands. So there could be some corporate complex structures which could be there. And each of these entities might be doing certain things. Say, for example, in a corporate structure, which is very complex, there could be something where an IP might be vesting in a particular country. There could be a sales or a marketing force which is there in yet another country. R&D or research and development could be in a third country. There could also be the management or the persons who are taking care of the complete activities, or the brain behind the entire business transaction which is happening in this entity is in a country. That could be one set of structure a company could form. Or it could also be, say, for example, the company should be having certain types of businesses in certain countries. Depending upon, either it could be a manufacturing hub, could be a place where there is raw material availability or labor availability, or it could be something where they could get a maximum benefit for a manufacturing activity. They could also set up businesses, service businesses, where they could get the maximum benefit for a service transaction. A trading business could be said where there could be a logistics service provider, companies are available, and it could be easy to purchase and sell goods in those kind of countries. So these are kind of structures which might be done depending upon the business scenario. And the corporate or complex structure certain times could also be, there could be a cross-holding which is happening. So there could be also be a situation where, say, for example, a company in Singapore might be holding an entity in Dubai, and then the entity in Dubai might be held by a company in Hong Kong, that Hong Kong might be held by Singapore again. So there could be certain things which should also be complex depending upon how the transactions flow. So in this case of Vodafone International Holdings, there was a complex corporate structure which was there because it was spreading across multiple jurisdictions. The Indian tax authorities claimed that they were claiming it was liable to pay taxes on the gains made from the sale of shares, arguing that the transaction effectively involved the transfer of Indian assets. So what was the entire crux of the transaction is that it is not that the Indian company shares was sold. It was the holding which was through a complex structure where the sale happened. And incidentally, since the Indian assets were also getting sold in the transaction, it was pursued that it was sold. It was an indirect transfer, and hence the argument of the Indian tax authorities had that it has to be offered to tax in India, because ultimately there was a transfer of Indian assets also which was coming out of this particular transaction. So in the High Court, it was ruled in favor of Vodafone, stating that the transaction was not taxable as it did not involve the transfer of capital assets located in India. The court emphasized that the legal structure was legitimate and within the framework. Okay, we saw how in the earlier slides, how the double taxation avoidance agreements is of utmost importance because it is not only talking about tax evasions and tax laws alone, it is also talking about the investment agenda or a strategy of different countries, and sharing of information, exchange of information between countries could be one of the priority what they have, or it could also be other economic ties what they want to have, or it could also be promotion of the other country in terms of making it a developed nation. So it could also be, there could be several agenda, and this is what something which will be agreed or discussed at the international forum between the countries, and the governments are involved in framing those double taxation avoidance agreement. So if that be the case, and there is a structure which has been designed, and there are jurisdictions which is giving a benefit for a particular entity, it was argued that it is a legitimate way of conducting your business. There is nothing wrong in doing a particular transaction if it is legally allowed as per the existing provisions of the tax in the respective jurisdictions and also in the double taxation avoidance agreement. So long it is within the framework of the international tax laws and within the framework of the domestic tax laws, which is also giving a link to the double taxation avoidance agreements, and there are also enough business reasoning for having a particular transaction, I think that should be a legal transaction unless and until they have a hidden intention of a tax evasion or other modes of doing a treaty shopping. So the Supreme Court specifically said, it confirmed that Vodafone was not liable to pay tax on the transaction, and the court also concluded that the acquisition did not constitute a taxable event under the Indian tax law, and they reinforced the principle of international taxation. So foreign entities engaged in cross-border transactions would not be subject to Indian tax liabilities unless there is a clear connection to Indian assets or activities. And this case actually highlighted the importance of respecting legitimate corporate structure, because the moment there is a particular provision in the Income Tax Act in a particular country, the companies establish their transactions or businesses in view of the complete tax position what is available in that particular country. So when a company is forming, say for example, a company X which is having a global presence, it wants to establish its business in India. So what does it do? The first place, it ensures that what are the tax laws available in the country? What about the direct tax? What is the indirect tax available? What they are supposed to pay on a GST or a customs? And what is there on the direct tax? What are the withholding tax provisions they have? What are the compliances they need to take? And only then a company is formed. Having said that, when the company is formed, the provisions of the various acts as of the date of forming the company is looked into for forming the company. So it is not good for the country to just have a retrospective amendment or then introduce a new provision to say that this was the intention of the law and this was not the one which was actually explained in the particular act. So that is what is the crux. So Supreme Court actually put at rest saying that if a particular framework is there between India and the other country, and if intention or at the time of framing that act or at the time of framing a DTA, the intention was a particular item should not be taxed in India, then by no stretch of imagination, at the time when the actual transaction happens, we can bring the particular transaction into tax net. So that is what it has been proved. So it is of great significance to ensure that at the time of entering into a transaction, what are the provisions of the act in India and also the provisions of the act in the respective countries, and what the DTA double taxation avoidance agreements talk about this, and then that's the one which will be framed at the time of transaction is entered on that particular date. So the crux of the case in this particular thing is a transfer of a foreign company between two non-residents when it happens, that is between Vodafone and Hudson Telecommunications. It will not amount to the transfer of a capital asset situated in India. Therefore, Indian tax authorities have no jurisdiction to tax the offshore transaction under the income tax provisions. The court also held that indirect transfers of Indian assets were not taxable under the law at that time. So what it meant is, the Supreme Court meant is, that law on the particular day when it was there, so it didn't have the provision to tax the indirect transfer. So this transfer happened between two non-residents, wherein ultimately the Indian assets are getting transferred. The shares of the Indian company get transferred. It doesn't mean that it will be taxed because it was not available at the time this provision was entered into. So there was, as a result of the Supreme Court amendment, what happened? There was an amendment because there was this judgment which was given on the Vodafone case. There was an amendment which happened, which said explanation 5 was amended by taxation rules. In essence, it said the amendment was to be, there was a little bit of a confusion whether it has to be a retrospective amendment or it has to be a prospective amendment, but it has been put into effect saying that it has to be only prospective. It cannot have a retrospective. So indirect transfers are taxable on a prospective basis. So if any company, any country is entering into a transaction as of today, then they need to also take care of the indirect transfer. But if the transaction has already at the time happened before, then there cannot be a retrospective amendment to tax the indirect transfers. Okay, we saw a lot of case landmark judgments which happened in cases of international taxation area, whether it could be on whether royalty withholding tax is available on the royalty, or it could be something on a fixed place PE, or we are talking about the case law on whether capital gains is taxable, even though the DTA provisions did not mean to it, or what is going to happen on a prospective amendment or retrospective amendment, or its case of Nestle, wherein it was the most favored nation clause. There was a clarification which said the notification has to be done. So we saw all these landmark judgments, which is basically of great importance for the CA practitioners, because in effect, this is going to not only for the practicing chartered accountant and also be on the chartered accountants who are in industry, because this is going to have a ramifying effect for all the transactions which is entered by the Indian entity or the Indian company with its non-resident entities. So it could be a transaction where it has to be a withholding tax has to be put in, or there could be a structuring which is happening between a holding company and the subsidiary company in India, or between the associated entities. So it has to be ensured, because there are landmark judgments which is clarifying certain points, especially the Formula 1 which talks about a fixed place PE. This is often quoted in most of the structuring advices for the simple reason, when we talk about a permanent establishment which is getting established in India for carrying out certain transactions of the holding company in India, we have to not only see the service PE. Service PE is basically the through the employees who are performing the activities, is there a permanent establishment created for the associated enterprise in India. It also has a fixed place PE, which is going to also have a wide meaning here, because that is also going to create a PE here. So all these landmark judgments is of great binding on the transaction which is entered into between the Indian company and this. Now we are talking of this case law is about Norbrimse, even though this is not something which is which we would say that is a judgment passed by the Supreme Court. This is a case which is often dealt with at the transfer pricing assessment level. So this is something which the department always quotes it, even though there are favorable decisions happening for the same company on the same topic. These are this decision is often quoted to stress the need for documentation when it comes to a transaction between the international transaction between the associated enterprise and the Indian entity. The crux of the case in this case of Norbrimse is that when a particular transaction is used, say for example, we talked about the transfer pricing provisions talks about various methods for substantiating the arm's length price with the comparables and the entity which is the tested party. So tested party is the party where we are going to do a TP analysis for an entity who is going to be the tested party. And that tested party is normally, as you're aware, is the least complex party. So now when we are comparing an Indian entity, we are saying Indian entity is a tested party, and that tested party's transactions are compared based on the function risk profile and asset with other set of comparables. And that comparables percentile method, which is used between 35th and 65th percentile, and the arm's length pricing is determined. The transaction net margin method can be applied for all the transactions of the company, which is interlinked between them. So what is meant by this is, say for example, a company in India is having a transaction with a non-resident in, say, it is in Germany. So now this A company is having purchase transaction from B, and it is also having some sale transaction. There is also other service transaction which is happening between these two companies. So it is not, even though we have to see transaction by transaction, what is the method to be used. If transaction net margin method is used, it is an all-pervasive method when we are comparing the profits of the tested party with the profits of the comparable companies. If that be the case, then we can also apply the same method for the services rendered if this service rendered is interlinked to the main manufacturing business or the main business of the other entity. So that is what is the crux when we do a TP analysis. It is always an accepted phenomena that when a transaction net margin method is used for a purchase transaction or a sales transaction of the entity, and if there is a service which is also incidental to the main activities, then a transaction net margin method can be also used. So this is how most of the transfer pricing methods, when we follow, the TNM method is being used for transactions. But in this particular case, there was an objection raised by the transfer pricing officer saying that for the company has used transaction net margin method for its other transactions, purchase transactions. However, the transaction net margin method was also used by the company for its professional consultancy services and management support services. The transfer pricing officer mentioned that TNM cannot be used for this method because it is a different set of transaction as compared to the purchase transaction or other transactions of the company, and comparable uncontrolled price has to be determined, and hence for this particular transaction arm's length pricing is nil, and hence the entire cost which is paid as a consultancy services and management support services to the associated enterprise has to be completely added back. In the sense, it will be the ALP adjustment. Since the ALP adjustment has been taken as nil, the entire amount will be added back to the income of the assessee, was the stand taken by the TPO. So then this CAT appeals passed a favorable order. But again, what is very crux in this case, because this is the case law which is used most of the times by the TPO when we are talking about the services which is rendered by the associated enterprise to the Indian entity. So in this particular case, it was said that there was nothing which was brought on record to substantiate AE provides similar service to an independent enterprise in comparable circumstances, and hence we cannot use CUP. So when can comparable uncontrolled price to be used? As you are aware, it can be used only when the same set of services is rendered by the associate enterprise to the Indian entity, and a third party also renders a similar service to the Indian entity. Then we can compare both of this. If there is nothing on record to prove that a similar service is rendered by a third party and only associate enterprise is given it, so long there is a business reasoning and rationale which is given, then it can be substantiated. Then CUP cannot be used just because the and CUP cannot be used and the ALP cannot be determined as nil and the addition cannot be made. But what is coming out of this case law, why the transfer pricing officer are using this case law in TP assessments, is mainly because of these parameters which are the points which needs to be noted for any transfer pricing assessment. There is a receipt test, need test, and a benefit test, which has to be compulsorily looked into these kind of transactions. So say, for example, if there is a purchase of goods between an associate enterprise and an Indian entity purchase goods from the associated enterprise, you have the documents which is at the customs, the invoice is available, there is a purchase order, and there is a transaction which can be proved for the customs purposes. And in certain type of transactions, there is also public data available. When these are branded items, even those items can be compared with the purchase items which is available in the public database. So that's on the purchases. When there is going to be a sales, again it passes through the sale of goods, it passes to the customs channel, and you also have the complete details available for you to substantiate that indeed there is a goods which has been transferred from one country to other country, and this is the price at which it is there, and it has passed through the customs of the both the countries. When it comes to services, the services is intangible. As you're aware, services are intangible. There's nothing which can be proved that a service per se is something which has been transferred. So when a service is rendered like a software development, so there is a software development service, then there is a tangible item in the form of a software which is available, or a software key is available which can be used for running a program, and that's a test to say that there is a transfer of a software which has happened. So in the case of a BPO service, a business processing unit is set up in India and it is doing an associated enterprise job, then there is also a test saying that this many invoices have been processed, this many bank transactions has been processed, this many accounts receivable and accounts payable process have taken care, and that is also giving a it's establishing a proof that there are services which is rendered. But when it is going to be a kind of a management service, there is a very thin line to call a service as a management service or a proper service which is required by the Indian entity from the group entity. So in most of the cases, what happens is, let's take a hypothetical case of an Indian entity which is having transactions in India. There is a global purchasing team which is set up in, say, Singapore. So this entity in Singapore, its job is to do a vendor evaluation, screen the vendor, get the terms and conditions of the vendor, and then finalize, say, 3 or 4 vendors will be quoted. They will have a quote, comparative quote, and they will publish this data to all its subsidiaries or its associated enterprise. And Singapore is supposed to be the purchasing hub for the entire organization. So this MNC has, say, for example, we talk about this MNC having subsidiaries in 10 jurisdictions, and Singapore is the holding company which is doing this purchasing activity with a group of team members who are working there. Now, for any company, for doing a purchase, it need to have a purchase department which has to do all these services. But since there is going to be a purchasing hub in Singapore which is performing all these transactions, so it is the activity of the Indian entity or the purchase department in India has to just take these 3 vendors which has been selected for getting a particular item or raw material, and then conclude the contract with them, do a price negotiation, conclude it and sign off the contract and go ahead with this. So they don't need to do a vendor evaluation. They don't need to see the vendor performance. They are not required to identify the vendor. They are not required to get the quantity discounts, what is there, because it's also made globally. There will also be some quantity discounts, and also there could be some price negotiation which can happen in the subsidy, and then they can enter into a contract. Similar is the case with, there could also be a common marketing function which is set up in, say they have another company which is having a marketing setup in Singapore, which is doing the marketing services across the globe. Then the marketing activities are performed centrally. So there is no separate marketing department in India. Similar is case with, there could also be sales promotion department. So it could also be a centralized IT services. So this is where it's very crucial. When there is an information technology service which is provided for any multinational company, you have a brand, and there is also a way in which your emails have to be drafted, or the emails look has to be in such a way. There could be a SAP or a SAP maintenance which could be done, or they could have some ERP package which will be maintained by their associate enterprise. There will be a central information technology team. If there is going to be a backup which has to be taken, or a disaster recovery plan which has to be done, it will be the central team which will be taking care of it. The persons locally in India might not have a full-fledged IT team. They may just have 1 or 2 people to just coordinate with their central team. So normally in any multinational companies, this kind of activities do happen, because there are 2 things available here. One, they want to ensure that the entire organization is reaping the benefit in terms of volume discounts, or it could also be they want to have a centralized team which can monitor all this, because in a big organization there could also be there could be other things. IT threat could be there. They have to need to have a firewall to protect their data, confidentiality of their data protection is a key there. So in all those kind of things, it is always better to have a centralized IT team. So they might have a centralized IT team, and what happens is this centralized IT team will have a set of people who will be providing services for all the subsidiaries across the globe. So these services, since it's performed for all the subsidiaries, obviously it's all services rendered by the common pool of people in IT department or purchase department, which will be billed back to India, or say they could also have a subsidiary, another subsidiary in, say, Dubai. They will be billing all these services in the ratio of, they might have a allocation key for allocating these services. So what the transfer pricing department normally comes with the view is that these services are management services, and hence these services should not be charged back to India, and hence it will be disallowed and then added back as your income. So what is very, very important in the TP assessment case, even though there are enough decisions to say that it's a business decision, we don't need to get into the entire transactions. What is primarily required at the time of transfer pricing assessment is that there should be a receipt test, which is the services have been actually received. So how do you demonstrate that? So if you're talking about an IT function, what I talked about, then if there is an issue in the ERP system, there is a complaint which is lodged by the Indian entity to them, and that log is maintained. So this could show as a proof saying that there had been the associate enterprise which is supporting them. Or it could also be the purchase function, what we talked about, a vendor evaluation. There are documents to prove that the vendor evaluation is done, screening of vendors is done by the associate enterprise. So those kind of things will be there. And this receipt of services have to be clearly documented. So there is something also called a need test. Need test is if, say, for example, the associate enterprise in Singapore is not performing this IT functions, or it is not performing this vendor evaluation, will the Indian entity be required to perform these functions? Yes. The answer is yes, obvious. Because if you don't do it, you're not going to make a purchase order and you're not going to have it. So there is also a need that these services are required. If this is not performed by the associate enterprise, this entity in India is required to place this order for services from yet another third-party service provider or an independent party. So there is also a benefit test which needs to be proved, where we say that there are tangible or intangible benefits which is derived. It could also be an economic benefit. It could be a commercial value from the receipt of service. Like there could be a situation where you will have an improved operations. Your employees can be trained using that particular thing, could be a benefit. So what is required is, in the case of TP assessments, especially if it is not a tangible goods purchase or a tangible service purchase, if it is going to be services, if the services is pertaining to your main service, which is basically your software development, or it could be a BPO service, or it could be a KPO service, the proof for the benefit is already available in forms of documentation. But what is not readily available could be your services, which is centrally done by the associate enterprises in the form of a central function for the benefit of all the subsidiaries or all the associate enterprise across the globe. And hence there is what you need to have a very clear documentation in terms of giving the receipt test has to be passed on to say that there is a receipt of services which is there. And you should also say that there is a need which is requiring that particular organization or the entity in India to require the service to be performed by an associate enterprise. And there is also a benefit which is derived by this Indian entity to do this. So what could be the documentation which is there? It could be emails, it could be some sort of minutes, it could also be other documents to prove that these three are established, but it requires a volume transaction. So this is the first part which will be required when there is a intra-group services which is performed. So that's a point number one. Point number two is, what is the kind of margin we are going to have in this intra-group services is something again a question mark. Here, Safe Harbor rules talks about an intra-group services with low value adds. Intra-group services can be done with a margin of say 5%. So that could also be there. So there should also be an agreement first to prove that what is the kind of services which is rendered, what is the need for those services, what is the benefit the Indian organization is derived, should be clearly documented. And also an agreement to say that what are the services which is rendered between the entities and what is the kind of margin which is incorporated in this agreement for these entities to get it. So then this requires, if this is there, the third important factor is what is the method we are going to do to substantiate this transaction. So the method in this particular transaction is, if a purchase function we are talking about for a manufacturing entity in India, if it is going to have a purchase function, and that purchase function of vendor evaluation, which is one of the main elements of a purchase function, is done by another associate enterprise, obviously it is closely interlinked with the main function of the manufacturing activity which is performed by the entity, and hence it has to be interlinked with this. So if your main objective of purchase function is substantiated under transaction net margin method, then the company can also say that it is interlinked with the main objectives, and hence TNMM can be used. So there should be real documentation to provide all this need, receipt, and benefit, and also the basis on which an agreement to show the basis of the services which is rendered, and also the percentage of markup which is charged on this transactions, and also how it can be substantiated in the form of an arm's length pricing. Okay, with this, we end the landmark judgments and also the transfer pricing assessment, which is the important crux in any TP assessments where intra-group services, how it's managed. And if you have any questions, please feel free to put it in the chat box.
Yeah, participants are requested to post their queries in the chat box. It was a wonderful deliberation, Madam Sudha.
Yeah, thank you.
We just wait for a minute to check whether there are any questions.
Yeah.
If you can just switch on your video. Yeah, thank you. You will be sharing the PPT, right, ma'am?
Yeah, I'll share the PPT.
Yes, participants are requested to share their queries, questions in the chat box, if any. I think tax audit season is taking a toll on our professionals.
Yeah, obviously. In fact, I was surprised that this session was arranged in the month of September, and that to the
True.
it was
Very
the
true.
end of September, so people will be busy in doing their tax audits, and of course, some of the cases statutory audits too.
Yeah, true that. Yeah, I know.
Yeah. So there are no questions. So if in case you have any questions, feel free to send it across to ICAI, who will forward it to me, and I can answer through mail. So thanks
Yes.
a lot for your.
Yes, I think that will also be a better option.
Yeah.
If not today, I mean, even later, they can always
Yeah.
mail the questions. So, ma'am, with your permission, should we wind up the session?
Yeah. Yes, of course.
Yeah, I think. So again, yes, good evening from my side. It's an honor, and I'm really lucky to have been given this opportunity to conduct this session as an MC. I would like to thank CA Sudha ma'am for discussing in a simple and a very lucid way the various critical points related to DTA, concepts like treaty shopping, MFN clause, made available clause, distinction between use of copyright and copyrighted, arm's length, price, transfer of shares between two non-residents in case laws related to international taxation, and a very special case law on Norbremse India explaining TP assessment with respect to transfer pricing pertaining to Nestle Inc., Vodafone, the Buddha circuit. I would also like to thank Mr. Ratnavel and Mr. Ilayaraja at SIRC and the entire admin staff at SIRC for their support for conducting this webinar today. I also thank SIRC for taking up this initiative in organizing such a knowledgeable, enriching webinar. And finally, a big thanks to all the attendees for being part of today's webinar and for making today's webinar a success. Signing off for today. Thank you so much, everybody. Thank you, Sudha ma'am. Thank you, attendees.
Yeah, thanks a lot.
Yes. Bye-bye.